In my 44 years of watching the gold market trade, seldom, if ever, have I seen so many primary fundamental gold drivers come to bear on the gold market in one place at one time, driving the gold price to all-time highs. And in the last 2 years, we have a new major fundamental factor that's come into play that could substantially drive gold higher over the next several years. I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. And in this deep dive into what's been driving the gold price over the last 6 years, I'm going to get into the market drivers, higher and lower, and explain how I think they will come to bear on the market in the future. Let me share my screen. We'll get on with my presentation. So I'm president of American Gold Exchange. We're a national physical precious metals and vintage US gold and European coin dealership, making competitive markets, buy and sell in these products. Let's take a look at the fundamental gold drivers over the last 6 years. Fundamentally, in the big picture, gold has been tracking US debt higher. This is a chart of US debt going back to 2000. You can see in the bottom left, we started about $5.7 trillion. It took us over 200 years to get to $5.7 trillion. By 2004, we were at 7 trillion. By 2014, 10 years later, we were more than double at 17 trillion. In the last 10 years, from 2014 to 2024, we've doubled again to almost 35 trillion today, which begs the question, in the next 10 years, between 2024 and 2034, are we going to be at 68 trillion? At today's higher interest rates, with the current $35 trillion in debt that we have, our estimated interest expense on our debt is going to be almost 900 trillion this year, higher than anticipated defense spending. And the government has already told us a couple of months ago that Social Security and Medicare are probably going to become insolvent in 2035 and 2036. So the US's accumulation of debt knows no ends, and that's helping to drive the gold price higher. Here's a 20-year gold chart, and you can see the trend line is following our debt higher. But due to the great financial crisis in 2008 to 2011, gold got ahead of itself. When we had a good economy in 2017, 18, and 19, gold got a little under trend. And over the last 5 or 6 years, we've gotten back into the upward trend line that we've had since the early 2000s. Now, I'm specifically going to go over the gold chart since about 2019. This is where all the primary drivers of gold come to bear. So, what are they? We've already said gold has been tracking the debt higher. On a short-term basis and a medium-term basis, gold tends to inversely correlate to the dollar's value internationally against other currency and Treasury yields. As the dollar gets stronger, gold tends to get weaker in dollar price and vice versa. Most of the gold around the world is bought in dollars, but it's bought outside of the US. Europe buys about twice as much gold annually as the US does, and Asia, including India, buys about twice as much gold as Europe does annually, physical consumption. So when the dollar becomes stronger, gold becomes more expensive in other currencies, which dampens demand. And when the dollar becomes weaker, it tends to make the gold price cheaper in other currencies, enhancing demand. That's the inverse correlation. Now, with yields, if you can get a yield on your money that's above the rate of inflation, a positive yield, that hurts the gold price because gold doesn't offer a yield. But if the rate of return on a yield, say 10-year Treasury is at 4.25% and inflation is at 5%, well, that is a negative yield. That tends to help buoy the gold price. So that's the inverse correlation to the dollar and Treasury yields. Gold is also a hedge against economic and geopolitical instability. It's also a hedge against currency debasement, which is what inflation really is, a loss of purchasing power. And over time, gold tends to hold its purchasing power against fiat currencies that have no backing. So let's get into the 6-year gold chart and take a look at how these different drivers have come to bear since 2019. Well, I remember early in the spring of 2019, gold made a run from about 1270 to 13 and a quarter, and it was a dead quiet market. And I said to myself, what's making the gold price go up all of a sudden? Because nothing else is happening. Well, at that point in time, we had come out of the great financial crisis. The Fed had cautiously raised the federal funds rate from 0 in 2016 to a high of 2.5% in 2018. And the 10-year Treasury yield was hovering at about 3.5% in the fall of 2018. So here's a chart of the 10-year Treasury yield in red and the federal funds rate. As you can see, the federal funds rate peaked at 2.5% in October, actually in December of 2018. Their last rate hike, cautiously coming out of the great financial crisis. That's as high as the Fed got the rates. But the 10-year Treasury had gotten to 3.5% during the fall, October of 2018, and it started to skid lower. So you can see here how the Treasury yields are coming down before the Fed cut rates. This is important because it comes to bear into the market today as well. Here are yields falling, the red line coming down before the Fed starts to cut rates. When I saw that was happening, I said, well, if the yields continue to fall, that's the key that can unlock the gold price to go higher over 1375 an ounce for the first time in 6 years. And it looked very promising to me at the time. So we put out an email to our database on June 4th when gold was 1330, and I called it Turning Point. And sure enough, just a couple months later, after the Fed made their first rate cut, gold broke out to 1520, to a new short-term high and over 1375 for the first time in 6 years. Let's take a look at that on the gold chart. Here's the breakout. Falling Treasury yields got gold over 1375, ultimately to about 1560 before gold started to correct back down to about 1463. Well, what came next? That was COVID. In March of 2020, COVID occurred, creating economic instability with economic closures in the US. So we had a liquidity event. That's that V-shaped sell-off that was very violent and very sharp. And then gold ran up to about 1750 an ounce and channeled there. So we've got a breakout on falling yields, falling federal funds rate, because this is where the Fed started to cut the rates aggressively in the face of these economic closures. And now we've got a US debt explosion with $6 trillion in stimulus, which punched the gold price all the way up to 2069 at that point in time, which created a top at about 2050. Let's call it 2050 for our purposes. As we got further into 2020, and we realized that the economic closures weren't going to be the end of the world, we figured out how we could start to live with them. Government stimulus helped to supplement the loss of economic activity in the country, and the vaccines started to come out. Gold found a floor at 1700. So we're now in a 1700 to 2050 trading range, which is higher than the trading range we had for most of the great financial crisis, when gold traded between 1550 and 1800 for the most part. And just as gold is finding some equilibrium and getting steadied around $1,800 in the very early part of 2021, Russia invades the Ukraine. And that punched the gold price all the way back up to the peak at 2043. Now we've got geopolitical instability. Well, it was also in early 2022 that inflation started to ramp up. And here we go, hedge against currency debasement and inflation. But something unexpected happened. While inflation was running hot from early 2022 into the summer of 2022, ultimately at 9% in July of 2022, that's where inflation peaked, the Fed reacted by raising the federal funds rate. This is a US dollar index chart starting in February of 2021 with the index trading primarily between about 90 and 95. And then as we get into early 2022, the Fed begins the most aggressive rate hike cycle in a generation. And you can see how every time they raised rates a quarter point, a half a point, 3/4 of a point, twice, the dollar became stronger and stronger against other currencies. The US raised rates higher and faster than every other government around the world to fight inflation. Because our markets were more stable and we had a higher interest rate here in the US, there became an interest rate differential that was positive for people in Japan, in other parts of Asia, in Europe, to bring their money into the US for safety and a better return, because central banks around the world were not as aggressive at this point in time as the US government was. So you could get a better, safer return outside of the US than you could in your home country. I'm sorry, inside the US than you could in your home country. So a lot of money from Europe and Asia came into the US, buoying up the dollar. To get into our treasuries and to get into our stock markets, you've got to buy the dollar first. So the dollar caught a very sharp bid. This is a clean chart that shows how much the dollar actually went up. It went up from 95.5 on the index, peaking in October of 2022 at 114, 18% increase against the euro, the yen, the Swiss franc, the British pound. This is a moonshot for a currency. For currencies to move 4 or 5% against other currencies in the course of a year is a lot. And this was a gigantic move for the dollar. So what happened? It pushed gold down. Gold was pressured by a stronger dollar. It was as simple as that. And the bottom in gold at 1630 in October of 2022 coincided perfectly with the peak in the dollar. You know, I'm a good friend of Brian London, who hosts the New Orleans Investment Conference every year in the fall. And I was on the precious metals panel during the New Orleans Investment Conference in October of 2022. And my message to the audience at that point in time was gold is on sale because of the stronger dollar. And it was. Well, what happened next was countries around the world started to raise their interest rates too, to combat inflation as well, diminishing the interest rate differential. And that caused the dollar to fall. So the dollar fell, bounced off of 101 on the index, and then puffed back up to about 105. And the next move in gold, like the downtrend in gold, is a perfect inverse correlation to what the dollar did during this period of time. As the dollar got weaker, gold got stronger, punched up to about 1950, and then corrected down to about 1870 as the dollar fell and then puffed back up again. So this is a perfect three-legged inverse correlation to a strong dollar, a weaker dollar, and then a modestly stronger dollar. Gold's down, up, and then down a little bit. Doesn't get any clearer than this. And then, of course, we had bank failures in the spring of 2023 in the US. In March, SVB Bank and two other banks, Republic Bank and another, failed. And that pushed gold all the way back up to now a triple top at 2055. So you've got more economic instability at play here. And then as we went, that situation settled itself out. The government bailed out SVB Bank, took it over, put some more liquidity into the system. Gold went sideways, this time channeling around 1950. And just as it was leaking again in the fall of October 23, Hamas attacked Israel, opening up a second war in the world. So now we've got renewed geopolitical instability. And now the gold price isn't just hitting 2050 or 2070, it's touching 2100. It's testing a breakout, which ultimately occurred, taking gold all the way up to about 2440. Now, I must say that this entire run higher for gold from 1830 to 2440 and the peak, that first peak, coincided perfectly with Iran and Israel exchanging direct fire for the first time ever. So the conflict in Israel had a lot to do with this gold run. But something else came to bear during the 2022-2023 years. It was the de-dollarization movement due to the weaponization of the US dollar. Following Russia's invasion of the Ukraine, the US sanctioned Russian assets, seizing 600 billion in assets from Russia, freezing them out of the SWIFT international banking system. So countries around the world had never seen the US use the power of the world's reserve currency like we did after we sanctioned Russia. You know, when you have the world's reserve currency, you do have power. That's really what it's about. But we had been primarily a benevolent power until Russia invaded the Ukraine. But when that happened, we sanctioned them. We seized assets. We threw them off the international banking transfer system. So governments around the world said, hey, if they can do that to Russia, they can do that to us. So that created the whole de-dollarization movement. You've heard about the BRICS, Brazil, Russia, India, China, South Africa, wanting to trade outside of the dollar. Well, this is a map of the BRICS countries and the proposed BRICS expansion countries. It's a sizable part of the world. It's 50% of the world's population. It's also, in GDP, the BRICS and BRICS applicant countries combined are potentially larger than the US economy and about double the size of the European economy. Now, the US is still the biggest, safest economy in the world, and the dollar is still the world's reserve currency because in reality, there is no viable alternative to the dollar, and there won't be for some time. The requirements to have a viable world's reserve currency are transparency of markets, a functioning debt market, a bond market, free flow of capital, and trust in the system that it will continue, political stability. And the US and the European zone are the only countries and regions that have this ability. So there's no viable alternative yet for the dollar. But central banks that are wary of being in the dollar want to get out of it, but they need an asset to put some of that money into. Well, they became record buyers of gold over the last 2 years. This is a chart of central banks' net buying and selling of gold since 1950. You can see for most of this time leading up to 2010, that yellow area on the chart, central banks have been net sellers of gold, except for a few other years along the way. But once the great financial crisis started and governments around the world created a lot of new debt out of thin air, beginning in 2011, central bankers became net buyers of gold and consistent net buyers of gold for the first time ever. This is a chart that takes us now all the way to 2023. Now, for those first 11 years, from 2011 to 2011, central banks on average were consuming about 500 metric tons of gold a year. If the mines produce 3,000 to 3,500 tons a year of gold, that is about 16% of annual mining production. But following the weaponization of the dollar and the sanctioning of Russia, central bankers have been more aggressive buying gold. They've doubled their gold buying over the last 2 years. In 2022, central banks bought 1,087 tons of gold, and in 2023, they bought 1,039 metric tons of gold, which is now 33%, or about a third of annual mining production. And this is becoming material at the margin. It's because they need to have an asset that's liquid, that's trusted, that can't be sanctioned. And gold fits all of these characteristics. It's not that they want to, it's that they need to have somewhere else to put their reserves that's safe. And gold is a tier 1 asset in the international banking system. So this takes us through to 2023. Well, this is from the World Gold Council, and it shows that in the first quarter of 2024, that blue bar off to the right, central bankers have been on the same pace this year as they were last year. Now, we may not quite get a record year in gold buying by central banks at the highest price ever, which is where we are now, but their buying activity remains strong. And this is becoming material at the margin. Here is the new tag on the chart that shows central bank gold buying doubles from 2022 into 2024. And that coincides perfectly with gold surging towards record highs now at 2467, with a really hard bottom at 2300. So let's think about these factors for a second. You've got a breakout run in early 2024, taking gold over 2100 all the way to over 2400. We've got record US debt that shows no sign of abating. We've got geopolitical instability, 2 wars. We've got record central bank demand. The only thing that's really missing right now are falling yields and perhaps economic stimulus. If the Fed decides to cut rates, which everyone thinks they will in September, which is about 6 weeks from now, 2 months from now. So here are the drivers: tracking the debt, economic and geopolitical instability, currency debasement, inflation, de-dollarization movement, which is growing. It'll take a long time for it to get real traction, but they're working on it. And central banks have become record buyers of gold. To me, that is a major fundamental new driver that will have probably one of the biggest impacts on driving gold higher as time continues to pass. Now, in the short term, however, we're in a similar setup right now as we were in the spring of 2019, when Treasury yields were falling before the Fed cut rates for the first time. Remember, this is what led to the breakout of gold over 1375 for the first time in 6 years, falling yields. And the US economy is clearly slowing down. We're in a kind of a big rollover of economic activity. And it looks increasingly likely that the Fed will cut rates in their September meeting, mid-September. And that's when gold tends to do the best in the short term. So gold, I think, could be a lot higher than it is right now, 10 to 15%, which would put it into the 2600 to 2750 range. The reason I put this chart back up is you can see how gold was testing a breakout before it actually ran. It took a little while for it to get going once it broke the trend line. And I do think gold is headed, perhaps within the next 6 to 8 months, over 2600. Well, silver's trying to do the same thing right now. It's testing a breakout over $30, which it hasn't been over for years. And you can see the previous high of 48.60 with gold trading, with silver trading a little under $30 as I tape this. I think silver has even more percentage profit potential than gold does, and silver probably ought to be closer to $40 than $30 an ounce in the current market. So that's my presentation. Again, we are American Gold Exchange in Austin, Texas, our national physical precious metals dealer. If you like what we're doing, please subscribe to our YouTube channel and like this video. I hope you found it informative, and I will continue to advise you of what I see in the market as this market continues to transpire over time. So thank you so much for your time. Have a good day.